Welcome to the Millennial Money Canada podcast, a podcast to elevate your financial planning literacy so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. I'm Guillaume Girard, financial planner, and I'm with Sam Lichtman, founder and financial planner of Millennial Wealth Advisors. And for this third episode, we have our first guest, Matthew Shantz, a mortgage broker, and we will do a deep dive into the mortgage landscape in Canada. But before we dive into the bio of our guest and the episode, Sam, do you want to give an overview to the listeners of what we've been working on in the business?
Absolutely. So we find that there's two main seasons. Like we want to service clients. We also want to grow the business. So right now we're focusing on some business growth strategies. And one of those is social media campaigns. And so typically I found in the past that people are very responsive to these campaigns in January, February, and then in October, November, December. Summer months, not so much. And early spring, any sort of ad campaigns, anything like that is dominated by big financial institutions and tax giants who are looking to get the market share of DIY tax filing. And so it's interesting because when we look at it from an advertising perspective as a business owner, what's our return on ad spend? What's our essentially click-through rates? What's our audience engagement and those types of things? And so, yeah, it's been good. I think we ran our first week last week of this cycle, and we had some really, really positive results from that. And so, yeah, just I think right now on the business side, it's let's end the year strong. And over the past 2 months, from my side of things, it's been a lot of servicing clients, existing clients, and we do something loosely based on a concept called surge meetings, where instead of meeting every client on an individual 6-month schedule based on their schedule, we'll have a month where we do all of our semi-annual reviews for as many clients as we can that are available. Then we'll do our quarterly reviews in October for as many clients as that are available for that point in time. And then we'll do our annual reviews in January, February, all at once for as many clients as are available during that time. And then on those times where we're not actively servicing or planning, where there's always something lagging on the planning side, right? There's always clients that, hey, we've uncovered something in our semi-annual or annual review that needs ongoing planning for the next month. That's fine. But it lowers our servicing hours on months where we're not doing those types of meetings. And then that allows us to focus on some growth strategies and trajectories for the business. And right now, through social media campaigns, we've seen some really positive turnout for financial reviews and financial advice. And so that's really exciting. The growth side of this really drives me and gets me excited. And looking to see how far we've come over the past 4 years is really, really cool to see. And yeah, we're 2025 really strong.
Yeah. Just to give the listeners a little bit of context here. So we aim to have a touch point every quarter and then have an annual review. And that's where we differentiate ourselves as well. A lot of people we hear sometimes, I never hear from my advisor, or I never hear until I contact them. So proactively, that's what we put as a cadence. And of course, if there's more touch points required based on the priorities, this is what we address at that point in time. As far as social media, we took a different approach now as far as structuring not only the financial review, which is for $50, but also just structuring the whole process, which we spent quite a bit of time in tightening our process there. But so far, I mean, the ads that you've put out, the clients so far that we've that have booked a financial review with us are really ideal clients, which is amazing because the messaging is one of the hardest things to nail. Putting an ad or putting some content that will entice the right clientele to reach out and to book a meeting and hopefully becoming long-term clients. That's such a challenge. And I think the latest ads, you've been a master at this.
I know. I feel like if I wasn't a financial planner, I probably would have gone into marketing. But honestly, that's so many years of getting it wrong. And realistically too, it's basically listening to what our clients are telling us and saying these are issues that are important to us and evolving our process. So it's not even just, hey, we're saying this, but we're doing something else, right? It's, hey, this is actually how we do things. And if this is attractive to you, if this is what you're looking for, we may be the right fit for you. Let's book a review and see if that's the case. And so that's been positive, and hopefully we can keep that momentum going up. And just in regards to tightening our process around the financial review, it used to be a little bit more ad hoc, kind of tell me what you're looking for. Okay, yeah, here's where you maybe should go and this and that. But we really refined our process to give a ton of value in the financial review. My mission has always been to give value every step of the way. So whether we're having like a data gathering meeting, or whether we're having a initial meeting, or whether we're on phase 2 of our onboarding process and you're already committed investment client and we're just going through paperwork, it doesn't matter. We want to give value at every step of the way. And so one of the ways I thought we could deliver some massive value to clients was by restructuring our financial review to have some key takeaways, which are, in every financial review, you now get a tax projection of all the income taxes you're likely to pay over your earning life, or if you're in retirement, over the retirement lifespan. And then also a net worth projection, which shows you where you're at today based on your current activities. Where are you likely to get to depending on rates of return and the risk levels that you're invested in your portfolio, as well as for the clients that share their investment statements with us. We will be giving them an investment analysis, very easy to read investment analysis of what they're actually invested in, what the risk is, if there's any overlap, we call it, like they have 2 S&P 500 funds or something like that, maybe you could get down to 1, but also the fees that they're paying. So if they're working with another advisor or they're in ETFs or mutual funds, what are you actually paying? And are you getting that back in terms of advice? So we go through all of those things and leave clients with some key takeaways for that. So that's something that's going to be different this time around. And this next kind of cycle of financial reviews that we're doing, we're trying to leave with absolute massive value for a very small upfront cost.
Yeah. And it's really hard to pinpoint what we want to focus on, because there's so many things that you could do in a financial review, but you have to narrow it down to just a few things. Otherwise, people will be overwhelmed. So it's striking that balance between showing them what matters to them and highlighting the areas where there's opportunities for them to plan better or get closer to their goals, while also balancing, again, pointing out everything that like maybe they haven't attacked yet because they've put on the back burner or whatnot. I think one of the feedback that I've had from the one I did yesterday was around the net worth projections and just visualizing if they keep on this trajectory where they will end up, because people don't necessarily think that every single day, if they're on the right track and whatnot, whether you've applied strategies or you haven't. So that was very insightful for them as to see visually where they would end up by the time they retire. And this is tied to, of course, their lifestyle and their retirement goals as well, which is why we work backwards to today in order to help you position yourself optimally so that you can get there, with the most optimal tools that we have to help you plan, right? Whether it's through investments or tax savings or everything that encompasses financial planning. So yeah, it's been good.
That's amazing. Yeah, it's been interesting.
So Matthew Shantz is a mortgage broker and team leader with Dominion Lending Centers FC Funding. He brings over 15 years of experience in the mortgage space. He's worked as a mortgage lender and as a mortgage broker. He currently leads a team of 30 brokers and growing. And he's very focused on financial education and literacy in his approach, and hence why him and Sam connected originally and why he's our strategic partner. So whether you're purchasing your first home, renewing your existing mortgage, refinancing to consolidate debt or access your equity, or building an investment portfolio, Matthew and his team are happy to support you no matter where you're on your journey. With that being said, let's get to the episode. Matthew Shantz, welcome to the Millennial Money Canada podcast.
Hey, thank you.
You are our first guest, so you're setting the standard. Thank you so much for your time. And how did you meet Sam?
So, like most people, I probably encountered Sam first on social media while I was scrolling through and liked what he was saying. It resonated with me quite a bit, kind of the transparency and honesty of the conversations he was having. I'm an education-based salesperson myself. And so to have something like that was really cool. So I reached out and engaged him as my own financial planner. I made some very poor investment decisions during the pandemic and realized that, it was time to get that check and balance in my life. So I engaged Sam first as my financial planner, and then we kind of just grew from there quite a bit, actually, over the past couple of years.
Yeah, I remember the first time we had a conversation and going through that. And it's really cool to see where you are now as well. But I think a lot of times people look back on their investment decisions and they think, oh, I regret about how I did this. But in reality, a lot of it's just a learning experience. And the nice thing is we all have time to go and make some decisions that we wish we didn't make, and then a lot of people, we have time to recover from it. And I love where we're at now, because now it just becomes a relationship where we just bounce ideas off of each other. Hey, is this a good idea? Or what do you think about this? And then vice versa on the lending side. Hey, we need solutions for this. What do you have? What's a good idea? I came up with this theory. Is this stupid, or what do you think? And so it's
fun.
yeah, it's really good. Yeah,
It's been fun,
awesome.
and that's really the type of business relationship that I promote and I look for is, when I'm connecting with a referral partner, it's not just a referral partner, but I'm looking for that strategic partner, and I'm glad that we've been able to come that with.
Yeah, me too.
Can you talk about the team that you've built so far a little bit and what your plans are for 2025?
Absolutely. So, I've been in brokering for almost 20 years now. I'm a licensed agent for about 15 of those, and a broker for about the past 5. And, I always really enjoyed growing a team, educating agents, right? Helping build them up as well as my own business. And so this year we saw some fantastic growth from about 8 of us at the beginning of the year now to just under 30 on our team. And we look at like we're going to pass that number very quickly. And then hopefully in 2025, we're setting some very ambitious targets. We're looking to cross 50 agents, hopefully 60 is our stretch target. And get our volumes up to over $250,000 in sales, or $250,000,000 in sales. Sorry. So very,
So
very aggressive.
Matthew, what is it that, I think I know what it is that is attracting the agents to come work with you, because I think you take a very educational approach to all things mortgages, training. It's a very transparency-based approach, and it's a do what's right for your clients approach. Whereas I think a lot of people in the industry are just trying to make the sale, but you're training your agents to be in it for the long term and to make sure they build up the reputation, credibility, and network. But maybe if you can speak to some of why people are gravitating towards you. I mean, growing from 8 to 30 in a year and then having these goals.
I think it comes down to having a dedication towards training. I don't think there's a lot of people within this business that actually dedicate their energy towards training and growing others, and that service back to the industry, right? I think a lot of brokers out there, they're very busy and they're very protective of their time and their space and their knowledge, right? And that's great for their business models. Mine really is in promoting other agents and growing them and watching them succeed, right? And that means making a choice in business to have the availability, the time, the access to train your leadership team, right? Because I don't do this alone. I've got an incredible team of leaders that help support me, and you've met them, and they're highly experienced brokers and agents who share my vision of educating the next generation of agents, right? And so taking the time from a leadership side to teach them how to educate, train, overcome problems, and then also to make growth a focus point, right? I couldn't do this without the people that support me, right? And that will lead towards us achieving those numbers in the long run, right? I think, the transparency is amazing. A lot of brokerages say that they're transparent, and then don't tell the whole story. You can come to me and ask me anything. And that's the same with our principal broker, our managing broker president of the company, right? And many of the other managers.
Can you talk about the recent changes in the mortgage space and how that's impacting your...
Yeah, it's exciting because change is always good, whether it's new legislations and new rules that we have to adapt to, or lightening of those rules, or flexing on what we can do. And we're seeing the latter in this situation where some of the rules have relaxed a bit. And I think this is coming at a great time because, it's been a rough couple of years in the industry as a whole. Things have been a little bit unusual, and, people are finding themselves in challenging situations. Will this impact housing prices and increase them? Absolutely. All loosening of mortgage regulation results in, price increase because it makes it easier for people to compete, right? But, I believe it's going to provide more option. The main ones, of course, being CMHC, the mortgage insurers themselves, CMHC, Sage, and Canada Guarantee, allowing insured mortgages up to 1.5 million. I know the industry for a long time has been arguing 1.25 and pushing for that. And so to see the legislation come in beyond what was being asked was interesting. this is really going to impact the GTA and GVA markets, where we do see those prices in play. It's going to help a lot of the higher income, higher net worth millennials get into the housing market and actually buy homes, maybe not condos or townhouses, but actually get into, semi-detached or single-family detached homes, which were always just out of reach. It's going to, on the high end, reduce down payment saving requirements from, 100,000 down to around 175,000, right? So this 125,000. So create that 175,000 savings is significant, right? And maybe loosen up a little bit of the damage that has been done to the bank of mom and dad along the way.
So I have a question on this because I think you hit the nail on the head that lower qualification requirements, lower capital requirements to get into the market will likely increase or move a segment into the market that we're hesitant to buy into buying. But realistically, we're facing a situation where there are very high prices and still people are completely priced out of the market. And that won't, the problem is how do we lower prices so that our generation can actually get in? And I think that's a long-term problem that we're probably 5 to 10 years away from solving, because I think the only answer is additional construction. But I'm curious your thoughts on this, because while mortgage regulations are loosening, there's still really strict municipal regulations on building. And in my opinion, I don't think that we can actually see housing prices start to decrease until those municipal regulations start to loosen in order for land to actually be built upon, like especially in the GTA area specifically. This probably doesn't apply to Vancouver, or Victoria, but there's a ton of land that is just completely off limits for developing in the Greenbelt. And I'm not here to advocate one way or another, but that land is completely off limits. And so that being the case, how do we actually expand housing in the GTA and south of the GTA? Like, I don't see that housing problem being solved by looser regulations in the mortgage industry.
No, and then it definitely won't increase supply, that's for sure. They'll do the opposite and increase demand. And then there is tons of growth room. And one of the major issues that, and I've talked with my partners in the past about this, is what is the major delay in growing housing, right? And a lot of it has to do with utilities and moving water, hydro, sewage into areas, right? And less about the land itself, because there's just an immense amount of land along the 401 corridor that can be developed currently. And so we saw this in the Halton region recently, that they just recently received the water infrastructure necessary to develop, right? And there have been a lot of work for years on planning and staging for that, right? And eventually the infrastructure was built out. Now, Halton is going to be one of the largest growing regions in Southwest or in Ontario in the next little while, on that corridor between Milton and Kitchener, Cambridge area. We're going to see massive growth, but that's because it took so long to get the utilities there, right? That's a big problem up with the Greenbelt area, and why it doesn't actually make sense to grow up there or expand up that way right now is because it is so disconnected from the utility services at this point. You're better off to stay closer to the major urban centers that are already there. So the corridors between Kitchener, Waterloo, and London, the corridors between London and Windsor, and of course the corridor between Kitchener, Waterloo, and Toronto, right? And as you follow the 401, that's the ideal growth area, right? And so it's going to be municipalities getting off their hands and actually expanding on those services, and it's expensive, right? And so I understand, some of the delays. There's growth isn't painless, unfortunately.
Just quickly here before we move on, going back to the insured mortgage topic of getting mortgages up to $1.5 million that are insured, I just want to clarify, just so that, again, the people who aren't in the finance industry can understand actually what that means. Because previously the rule was up to $1 million, you can put less than a 20% down payment on property, which is called a conventional mortgage when you take that mortgage out, if I have that terminology correct.
So 20% down would be a conventional mortgage, right? And that's the standard that most mortgages would be weighed against. There is what's high ratio, insured, default insured, right? And when we're talking about mortgage insurance, I want to be very crystal clear that this is not something that benefits the buyer. The insurance on default insured mortgages benefits the lender, right? And so you'll often have confusion. Oh, my mortgage is insured. There's an insurance policy on. No. That's the lender having an insurance policy on your mortgage in case you go into default on it, right? And so anything that's got less than 20% down payment, high ratio mortgages, default insured mortgages typically have lower interest rates than your conventional mortgages, but there's going to be a premium charged. And, on the lowest borrowing amount, 5%, right? There's a 4% premium charged capitalized up front that's accrues interest. So it's technically not a cheaper solution than if you put 20% down, right? But it allows an earlier entry point into the market. Okay.
I have mixed feelings about the idea of being able to put, like, would you say $125,000 down on what would that get you? What?
So you're allowed 5% of the first 500,000.
So 25 there.
And 25 or 10% of the
10% of the next, 10% of the rest.
So 100,000.
Essentially, 25,000 would get you a $1.25 million home.
Yeah.
If I
1.5, I believe.
$1.5 million home. So having that capital, and then you add CMHC fees on there, which take away from the principal that you're putting down as a down payment. And essentially, the tiniest fluctuation in the real estate market has you underwater loan to value ratio. And for me, I'm like, is this actually a good thing? Like, I understand easier access into the market's good. I have mixed feelings about whether that's actually a good financial decision for people.
I think there has to be a shift in the way we think about real estate in Canada, period. Far too long, we've thrown the word investment around when we're talking about real estate. And real estate's not an investment. It's your home. It's the place you're going to live.
Yeah.
It's investing in yourself, absolutely, right? But
lifestyle
on its own is not a money maker, nor should it be a money maker, right? Your owner-occupied home is your home. Hard stop, right? And I think it would do everybody good to get away from the mindset that your home is your investment, right? Are there investment vehicles that can be utilized with the equity in your home? Absolutely, right? Can real estate as its own be an investment? Sure, commercial, mixed use, rental, things like that. Absolutely, those are investments, right? But your house isn't something you should be buying and selling every year, right? It's not a speculative tool, right? If you want to speculate, there's a whole great industry called cryptocurrency out there that gamble away, right? Go gamble, right? But real estate is not a gambling tool, right? And we were so used to it over the past, 8 to 10 years being this always up market that, people misunderstood what the heck they were dealing with. You don't gamble your house away. That's not your get rich quick scheme. Your get rich quick scheme is get a good job, make good money, invest it properly.
Yeah.
So
just a quick disclaimer here: we do not recommend investing in crypto.
No,
this is not a recommendation of crypto. However, I understand what you're saying. If you want to gamble, don't do it on your primary residence.
Exactly.
I hear you. Yeah.
And then it's one of those things where, if you're only going to be in a 1% equity position, sure, you've got risks associated with it, but only if you do something to actualize a loss in a property or a gain in a property, right? Real estate doesn't do anything until there's an action. And I always, one of the things that I teach new agents right off the bat is to never talk about the value of a property, because there is no value in the property until someone puts value on property, right?
It's like paper losses or gains until you make a decision. And that's why it's so important when you're buying a property to say, like, hey, we've got the income to support it regardless of the circumstances around my job. If we lose a job, we've got an emergency fund, we've got all of the financial capital and income to actually not only support this, but to more than support our purchase, so that we're not making a decision where we're house poor. I love that.
I'd like to take the discussion towards interest rates right now. So if you could just touch on the main factors that you think are overshadowing, the moves in interest rates, maybe just talking about the fixed and variable where we're at. And again, we're not here to make predictions or saying where it's going to be in a year from now, but maybe just to give the listeners a bit of color into like what you're seeing and what you think is impacting that.
Absolutely.
That side of the decision.
Similar to how there's a misunderstanding around what default insurance actually means, right? There's a lot of misunderstanding around the interest rates that we utilize in mortgages in Canada, right? And there's actually two very distinct interest rates that are used, right? And they're very disconnected from one another. you've got your fixed and your variable rates, right? One is dependent on bond yields, your fixed rate, right? And it typically tracks and moves along with the 5-year bond yield, right? And that's greatly impacted by movement in the Canadian and, more importantly, the American economy, because the Canadian 5-year bond is very closely tied to U.S. 10-year treasuries, right? And so the 5-year fixed is really just going to be that 5-year bond yield plus a certain percentage, normally 1.5% to 2% above that bond yield is where rates are going to fluctuate around. Okay. Sometimes that's much lower depending on if the markets, if they want to heat up the market or not. But you're typically going to be chasing that 5-year bond yield for a 5-year fixed rate. Okay. That one is going to be wait and see, in my opinion. We don't know what the U.S. is doing. I don't think anyone can anticipate what the U.S. is doing. My firm belief is the incoming American government loves chaos, loves to work in chaos, loves to be unpredictable. And I think we're going to see that reflected in the markets when it comes to bonds and treasuries, right? The variable rate is tied to the Bank of Canada overnight rate. That's then translated to the banks as a prime rate, right? And each bank has a different prime rate. Often they agree it's going to be similar, but every lender has a prime rate, okay? Which is essentially they borrow at the overnight rate from the Bank of Canada. They lend against their prime rate, okay? And variable rates are either going to be a premium or a discount against that financial institution's prime lending rate, okay? This one is tied more closely to inflation and the Canadian economy than I would say your bond markets are, right? And so right now, I don't think it's a surprise to most that, GDP's down, growth's down, inflation's way down, right? Oil prices are down, right? Everything's showing down. And so it makes sense for the Bank of Canada continuing to cut the overnight rate, right? There's what's called a neutral rate, which is where the big 5 banks and all their economists kind of gather together and think if overnight rate was sitting at this percentage, we would be at a economic break even, essentially. That's somewhere currently between 2 and 3% consensus is, right? We are much higher than that still on the Bank of Canada overnight rate. There's room for it to be cut, and that's going to be somewhere between 1.5%, 2% probably from where we're at today.
It's interesting because I was looking at GDP forecasts on the Bank of Canada, and this came out on October 23rd, because GDP is the leading economic indicator of how an economy is doing, and the poorer an economy is doing, the more the Bank of Canada will cut interest rates. And so we're looking at the 2024 expected GDP growth of 1.2%, which is really, really low. 2.1% in 2024, which is low. In 2025, my apologies, 1.2% in 2024, 2.1% in 2025, and 2.3% in 2026. That's the Bank of Canada's forecast for GDP growth. And so until we get a strong economy, we're probably not going to see rates stabilize or increase at any point in time. And we've had a pretty poor economy over the last little while. And so that's why interest rates are coming down right now, which is why variable rates are coming down. And it's interesting to hear the disconnect between fixed and variable rates. It's pretty fascinating.
And then it is, and I think we're gonna reach a delta point soon where we're gonna get the crossover where the variable is going to start being the more favorable option out of the two, just because of how the rates move. Don't quote me on it. I don't have a crystal ball. The closest thing I have to prognostication is a magic 8-ball I shake. And that's about it. But I think if we look at the trending, right, I'm not going to be surprised if in a couple of days Bank of Canada comes back with at least a 25 bit cut, right? There's another announcement in January. I think for the time being, we're going to see that, and everyone's going to start hollering, "Oh, but the Canadian dollar." We're an export nation, right? Generally speaking, a lower dollar is not a terrible thing when you're an export nation. It sucks when you're an import nation, that's for sure, right? And you're doing a lot of buying, but they won't let the Canadian dollar get super weak versus the US. There's mechanisms in play to, try and protect that. And, I think what's more important right now is stimulating, growth within the economy itself, however they can. And, lower overnight rates means lower capital costs for businesses, right? It means our lines of credit get cheaper. It impacts more than just mortgages, right? So business lines of credit, anything that's a floating rate, gets cheaper. And that's a big deal when you're looking at expanding your business, growing your business, right? And leveraging your credit lines in order to, reinvest back into your business, whether it's hiring, bringing on more inventory, things like that. So, I think the cuts are moving us in the right direction. I'm not an economist. I just listen to them, right?
Well, the saying is that economists have predicted 20 of the past 5 recessions, right? So
Exactly.
we always need to take them their forecast with a grain of salt. One thing I'd like to pick your brain on is, for a little while, because we saw the lows interest rates in 2020, is the mortgage renewal cliff still a worry that we should expect to see? And I'm not sure exactly the dates or the volumes when we should expect it, but looking at 2025, 2026, is this still in play, or what's your opinion on that?
But yeah, so 2025 is going to be a big year for mortgage renewals, right? There's about $350 billion worth of mortgages up for renewal in 2025. That's $100 billion more than was in 2024. That's significant increase in the market, and a significant portion of the market. 60% of all mortgages renew in the next 3 years. Okay. Yeah. And caveat, 70% of Canadians have mortgages. So it's not that everybody's going to suffer, but there is a large section of the public that will be impacted. Now, a doubling of interest rate does not mean a doubling of housing cost. I think, people don't understand interest rate to dollars, and that's okay. I don't think we're meant to understand percentages very well. I think it's a little bit outside our hunter-gatherer brain to really grasp percentages and what they can impact, right? So moving from a 2% to a 3%, a 3% to a 5%, right? These aren't going to proportionally increase our monthly payments by that amount, right? Because we also include things like amortizations and whatnot. There's a lot of other tools and mechanisms to reduce monthly costs, right? Is it going to hurt? Sure. Absolutely. Any more money out of the pocket hurts, right? But a very important thing to keep in mind is when in 2020, when a lot of the mortgages that are going to be up for renewal this year were underwritten, there was a stress test to 5.25%. So you had to qualify as if the interest rate was 5.25%. Now, I often look at things that, I qualify more expensively, and then I budget for lower, and then I overspend my budget, right? Absolutely. And I think most people are guilty of that. But what it meant was, when you were buying your home, on paper, most of us could afford a rate environment that's worse than today. Because if we look at it, a standard interest rate that someone would renew in today is somewhere between 4 and 4.5%, right? This is terrible versus the 2% you were, right? But you qualified for 5.25%. So
I think this is where inflation starts to really rear its ugly head, though, because your wage inflation hasn't gone up with the cost of living. And so even if their wages have gone up and they're renewing into a higher rate, their other expenses are probably higher now. Absolutely. And so that could still have a pretty big impact. So are you saying that we're not expecting to see that dreaded cliff of inflood of the market of flash sales because people can't afford their houses at renewal anymore?
I don't think that's going to be the case. I don't think that's Canadian. I don't think that's the way the Canadian home buyer works. I don't think that's how the Canadian homeowner works, right? I think that we pay our mortgage always, right? We don't have a walkaway policy or a return the keys policy like the US does that makes it easy to escape from your property if you are done and just fed up with it. There's some differences in the way the systems are put together, but also, one of those wonderful rule changes that came into play was a removal of the stress test on renewals when you're switching from lender to lender. That means that we're going to see some more competitiveness in the market on renewal clients, right? Where borrowers will have more option out there, because where previously you had to stress test renewing mortgages, right? That would limit the options of lenders that you could switch to. So at renewal, you can switch from lender to lender penalty free. And this is a big deal, because this means that, often I'm not going to work as hard to retain my clientele because you're likely just going to sign back on the dotted line. So I can offer something a little bit more expensive and you're just going to do it because you're stuck with me, right? This has removed that mindset from the market. Now there's competition on renewal. Now there's going to be a fight on renewal. Now, Sam, you can walk into me and you can go, hey, Matt, shop your 50 different lenders for me. Find me the best offer out there for my renewal, right? And we can do what's called a switch or a transfer and pick you up from TD and dump you into Scotia, right? If Scotia is going to give a better offer, right? So this added a competitive edge back into the market for borrowers who already owned homes. And any removal of the stress test on that was a good thing, right? Because we're not dealing with new money. We're dealing with money that you already qualified for, right? So there's on these, it's not a refinance, right? Refinance is new money, right? Renewals, transfers, switches is your existing funds.
So what you were saying is that big institutions were taking advantage of people's lack of mobility to charge them higher prices.
I don't think that would surprise anybody, right? You know, they've always bet money on you being too busy to read the fine print, right? I think that's going to be a change this year.
Can you talk about, given the size of the renewal, in 2025 that you talked about, can you talk a little bit about the tactics that are employed that we see currently by the major players to get a piece of that a very important business?
Absolutely. And this is extremely important business because business on the books really is a higher quality type of client versus new business, right? But many institutions spend a lot of money on acquiring new business, right? So what we're probably going to see are three tactics in play. I know there's three tactics I use when we're looking at renewals, right? One is, can I just beat the interest rate you have, right? You know, apples to apples, can I beat your existing interest rate with a new one, right? Is it time to make an adjustment or change in your plan, right? Because renewal time has the advantage of being a penalty-free time, right? You can make adjustments to your mortgage without incurring prepayment penalties, right? We can look at refinance options at this time. You know, refinancing is accessing new money in your property, right? This is a great time to look at consolidating consumer debt, outside debts, you know, high interest debts into your mortgage, reducing your overall monthly cash flow or improving your overall monthly cash flow, removing your cash flow obligations, right? This is also an amazing time to sit down and have a conversation about legacy planning, retirement planning, right? If you're in that position now, you know, we can look at what's going out the door for your mortgage, but now really begin to think, okay, I'm at 40% loan to value on my mortgage. Is it time to now move into a home equity line of credit product? Are there other options out there that are now more suitable for my lifestyle? Am I in a better position employment wise? So now I'm going to move from using fixed rates to variable rates, right? They give me a little bit more flexibility in how I pay, right? You know, this is a great opportunity to sit down and just get a full reassessment of your situation. And this is where, you know, team comes in, right? This is not something you should do on your own. This is something where there's the mortgage broker, the financial planner, right? An accountant. You know, you want to sit down and really assess tax strategy. Is there something, legacy planning? Is there something there, right? Investments and savings. Is there something there, right? Take the opportunity of your renewal to do a review of your current situation.
We've heard stories from clients and just generally people talking about how big institutions are pushing their clients to renew early.
Yes.
Why would they be doing that?
To you. There's no advantage to you as a client to renew early. Rates are in a downward trend. What they're betting on is fear, right? Fear of the unknown, fear of the future.
A lot of these people are in low fixed rates right now, and they're being told, hey, you should renew earlier into this new higher fixed rate. Is that just one example of big institutions trying to retain business? Because you were mentioning like, hey, business retention is, and I think from any business, retaining business is always a lot cheaper than acquiring new business. And so this is maybe just one example of trying to make sure that unwitting consumers who don't know that maybe the person they're talking to doesn't have their best interest in mind, they may be subject to paying more interest over the next year if they renew early.
Absolutely. So sometimes there's an advantage to renewing early, but we're talking about negotiating a year before. So for example, I've got a 3-year term mortgage that's sitting at 579 with one of the major institutions, and it may be in my advantage to reach out to them today and see if there's an option for an early renewal here, right? Can they blend the rates? Can they do something with the term that exists to decrease my payments today, right? So that I don't have to wait until 12 months from now to do something, right? But if I'm renewing within 4 or 5 months, we know the general direction of interest rates today. There's nothing that's no screaming, alarm saying that it's going to change anytime soon. If I renewed today, I'm probably going to be renewing into a rate that is higher than it would be if I went back into the market in 3-4 months and started searching, right? And so what we're getting a lot of is people's, as our emotions go up, as our fear goes up, our intelligence, our strategy goes down, right? And there is a lot of betting on fear and fear of uncertainty, fear of high rates, right? And the joke, the real joke is that rates aren't that high. They're just high on the 3-year mind, right? They're just high in our recency bias, right? A 4% is not a high interest rate. When I started in the business, it was six and change as a standard, right? This is when Guy was still in preschool, it's one of those things where, the 4% that we're in is not scary. It's just recently we're used to 2%.
It's funny because we're used to 2%, but higher prices relative to what, our parents may have been at, where they were getting probably close to double digits, maybe late 80s, early 90s. I guess it was probably lower then, but the housing prices were also much lower relative to income. And so
My
now
mentor started in 1988, and the stories I've heard from them are pretty crazy.
Yeah, double-digit interest rates. But also, I think, again, it's important to understand that, look, I'm a millennial. I have been in the job market since 2012, and I've only ever known free money from lending institutions, right? Because it's only ever been like 3% or less, which is realistically free money when you factor in the fact that, like, you can essentially go and use that money to invest if you want to, or even after inflation, it's really free money that you're getting from the banks at 2%. But I think the problem with that is too, if the lending rate's expensive, but housing is correspondingly very expensive relative to the median income, then we're still getting to a place where, again, it becomes a little bit tougher to still think about leveraging a high amount to get into your home. So it's interesting dynamics today.
Absolutely. And I think, it's one of those things, if you ask, would I rather have rate or low house price? I'll take low house price. Doesn't matter what the rate was, right? And that's the thing, right? It's about the dollars spent relative to the dollars intake, right? And I know it's such a cliche thing to say, but rate doesn't really matter. What's expensive for you may be different for me, right? And it's dollars in versus dollars out always, right? What makes the most sense for you based on that?
Good. Talking about rates, just historically, I pulled by decade. So just to give you an idea, in the 80s, we were looking at a prime rate of 22.75%. And then variable rates were 3 to 4% below prime. In the 90s, we're looking at a prime that averaged 9%, with a prime, a variable, minus 2% from prime. In the 2000s, we look at a prime rate of 4 to 6%, with a variable rate minus 0.5% from prime. In the 2010s, we were looking at 2.7 to 3.7% for prime, which is what you talk, Sam. Most of your career, you've known around the 3% mark. So did I. And then variable at that time was minus 0.5 to minus 1%. And then in the 2020s, prime fell to 2.45% in 2020, and then rose to 5.95 by 2024. And now we're looking at a variable plus 0.5, but then we're going to see that crossover.
Yeah, I think we'll return to those threes, is my guess, on the overnight rates. I think primes will be more in the fours, but I think, there'll be a happy medium, because we don't want free money per se. That's not
It's a dangerous experiment.
It is. It
Yep.
really is, right? Money should have a slight cost to it, but it shouldn't be crippling.
I just want to ask something here. So Matthew, what's your advice to buyers right now or people renewing that are maybe not knowing their options? Where do they start? Who do they talk to? How do they get educated about this?
I would love to say, come talk to me. That would be a first step, is engage an expert, right? Talk to seasoned experts who can sit down and build a plan. You either start with the financial planner or you start with a mortgage broker. But you're going to end up talking to both probably over the course of a renewal, and you should, because, everyone thinks that our natural fit is realtors, and I'm not going to poo-poo on realtors. I love my realtors, right? But the real relationship that exists is the broker and the planner, because we control the money in the situation. We're guiding the money path, right? I've got your biggest debt. He's got your investments, right? And you want to balance that out. So talking to both at time is vital.
Is there anything to watch out for? Like, hey, someone said this. I'm not sure if this is a good idea. Are there like one or two things you can say? Like, hey, if someone says this, make sure you get a second opinion.
Yeah. My friend said this. My family said this. My dad said this. I'm not gonna, again, not gonna poo-poo on your father or your friend or your family member, but they're not advisors unless they actually are. But in most cases, I can bet that they're not a trained individual. As much as the opinions of friends and family are important, they should not be taken as advice, right? Their opinions, right? And I think what is advice, right, versus what's an opinion is probably very important for a lot of people to make that distinction, right? You come to us for advice, right? You go to your mom and your dad and grandma and grandpa for an opinion, right? Based on your experience, what have you seen in your life? Based on what you know of me, does this work? Right? Yada yada. With us, it's here's the programs, here's the layout, here's the strategy, right? This is what we think you should follow. And I think it's important to not make your decisions based on opinions alone.
Talking about advice, a lot of our listeners and our clients are business owners, self-employed individuals. Can you talk about how they differ and how you advise them based on the uniqueness of the type of income that they get or differences that they have compared to employed individuals?
Yeah, and this is a huge area, and this is where I was, coming to when we were talking about rate not being as important as cash in, cash out, right? Because there's a lot of different rates in the market, and when you're getting into self-employed and business owners, we have just a whole slew of products out there that are designed to meet our unique needs, right? I'm a business owner. I categorize myself in this, right? I'm set up in a corporate structure, paying myself a dividend, right? My expenses are taken off top, right? And my taxes are paid at the end of the year. I'm not going to go into too much detail of exactly what that looks like because that's between my accountant and God, and the CRA. But what I know is what I pay taxes on is different from the money I generate, right? And, as a business owner, one of the benefits when it comes to mortgage lending is that I can choose at what point along the tax cycle to qualify your income. Right. I can definitely go and take your T1 generals NOAs 2-year average of your line 1,500 or 15,000 or whatever it is this year, right? And say this is what you've earned, right? But and I know that is not going to be reflective of what we actually generated as revenue, right? There are a lot of tax advantages that we can take that we can use and should use, right? That work well in our favor before we get to that line 15,000. And so there's mortgage policies that exist primarily through the challenger banks. So, there's 35 Schedule 1 banks in Canada, you can think of maybe 6, 7 of them off the top of your head, but there's 35 Schedule 1 banks, all right? And many of these are allocated to what's called a challenger bank. And they're going to utilize different mortgage lending rules than maybe your big 5 would, because there's a different risk profile that they've accepted. They're all OSFI regulated, and the rules they follow are given by OSFI, right? It's just their choice as an institution which rules to utilize, right? And so we have things like bank statement verifications. Give me 12 months of your business bank statements. Let's look at your deposit history and reduce it by a overhead, right? We're all commission salespeople on this call. All right. We don't carry massive overheads. It may be as high as 80-85% of what we generate in our business bank statements becomes what we qualify our income off of when it's coming to the time of purchasing, right? I may have a brick and mortar operation. Then I may have much higher overheads, but I may have much higher, gross sales as well. I could be a dentist with a dental practice, right? In that case, I may be looking at some retained earnings added back from my financials, plus, some goodwill, plus some of my dividends, right? There's a lot of different ways to get to that final dollar. Do they all generate the lowest interest rate? Absolutely not, right? But, I might rather pay 1 or 2, 3% higher interest rate per year on my mortgage than 40, 50, 100, $200,000 more in my taxes. Right, by showing every dollar earned.
So just to clarify this, so basically there's two methods you can pay yourself as a business owner. One way is salary, just regular compensation, and the other way is taking a dividend as the owner of the corporation. And so what you're saying is if you pay yourself a salary and want to qualify for, let's say, a big 5 bank type mortgage, then they will only look at your personal salary or dividend, personal earnings, in order to qualify you for that, which a lot of business owners don't pay themselves high salaries because they are reinvesting back in their business and they are just paying themselves what they need to live on. So It's harder to qualify personally. But then what you're saying is there's alternative routes where you don't necessarily have to pay yourself a $200,000 salary if you're not in a business position to do that, or you just don't want to do that. You can go based on your gross revenue minus your overhead expenses in your business. You'll be paying a little bit more in interest, but you will be saving money in terms of taxes because you don't have to pay yourself $200,000 from your business to do that, if I'm understanding that correctly.
Correct. Yeah. And there are programs that the big 5 banks will use. CMHC has a self-employed program, right? It's called Alt-A Stated, where there's a cash component in your business, right? And so you see this with trades a lot of the time. But these are really designed for businesses that cap out around 150,000 total annual earnings, right? And for
like
those
service,
service business.
So service businesses, trades businesses, where you're basically like a general contractor or a subcontractor of different companies, but you're not an employee, so you're able to incorporate. You maybe have 1 or 2 contracts, kind of thing. Okay.
Exactly. And so it's one of those situations where maybe it's worth shopping around a little bit or dealing with someone who's got a specialty in self-employed individuals instead of just walking into, say, a branch and dealing with, whoever's currently manning the mortgage desk that day to sit down and figure out what is the best from a tax strategy sense for your business, right? This is why we work very closely with accountants and why we work, again, very closely with financial planners. Because there's more to the mortgage than just I earn this. This is what my pay stub says. Please give me house, right? And especially when we move into the self-employed field, right? We have to really sit down, and it is document intensive, right? You could be asked for 12 months of business bank statements up front, right? And there's a little bit more work that goes into it, but if it lets you get into the housing market today, that's a huge advantage because today, prices are lower, rates are a little bit higher, right? But I would rather take lower prices on higher rates than higher prices and lower rates every day of the week because there's immediate equity growth when rates go down and prices go up, right? And you always make money in real estate when you buy low, sell high, right? So if prices are down, that's a great sign to shop, and if it's a little bit more expensive to get in, go short term. Think very short term on your mortgaging. Mortgages don't have to be 5-year fixed, right? They can be 1 year. They can be variable rates. They can be any number of solutions, right? But your time in market will always beat timing the market, right? Same thing with
sounds very familiar.
Yeah. There's nothing creative in finance, really. We just repeat the same old things that have worked for generations, So yeah, I would say, sit down, see what your buying power actually looks like if you're a business owner, right? See what opportunities and advantages are actually there as a business owner, right? Before you just walk in and say, here's my taxes, give me the best you think I can.
Can you talk about the options that people have as they near retirement to take money or improve their liquidity in their wealth that is mostly tied to any liquid assets, which is in their home? Could you comment on the few strategies that you're seeing right now that would make sense? Again, that might be case by case.
Yeah, that's a nice way of asking me to talk about reverse mortgages. Is really what it is.
Matthew, just before we get into that, I want to just put a quick clarification here, because I think the reason why we want to talk about this is because there are a lot of people out there who have massive net worths in their property, but don't have high liquidity in their other assets, right? They don't have a lot of investment assets, things like that. And so just kind of framing the conversation in the way, look, if you're in a position where you've got a large primary residence that you've paid off, but maybe you're late to the game in terms of savings, what's your options here?
And that's the thing. There's massive amounts of equity in property in Canada. We are very house rich. Very house rich. Unfortunately, we're very cash poor in all situations, right? And because we spend so much time becoming house rich, Canadians pay off their homes. They're good at it, right? Canadians are great with real estate, generally speaking. They're maybe not the world's best savers and maybe not the world's best investors, right? And so you end up in a situation in which you're hoping that the social safety net is going to carry you into retirement, and yet you're sitting on $1 million worth of real estate equity, right? What do you do, right? And there's a couple options that exist, right? Reverse mortgages are being advertised everywhere right now, constantly everywhere. And the reason being because of that equity situation. And, the institutions are smart. They know it, everyone's slowly starting to dabble into it. We're going to see it become more mainstream, right? Every couple months I wake up, oh, there's a new lender in this space. Oh, there's a new lender in this space, right? And, it's important to understand first and foremost, this is not the American model of reverse mortgages, right? You are not handing away the keys to your home. It's more reminiscent of a UK model where it's a part of the retirement strategy, okay? Do I think it's the optimum tool for everybody? No, I think it's very case by case, right? I think it's for people, I think it should be almost the last solution we look at, because what you're going to start doing is negatively compounding interest on your property.
Can you explain? Can you explain the ins and outs of reverse mortgage?
Yeah, absolutely. So you're going to qualify for a certain amount of access to your equity on your property based on your age. And there's an actuarial table that anticipates when you're going to die, and what the value of your home is going to be down the road. And you will be assigned a maximum of liquidity or equity takeout level based on that table. There's no income qualifying on this because there's no payments being made. Reverse mortgages, you don't pay anything. It's optional payments. So you could pay down interest if you felt like it, but that's sort of counter to why we take them. Right? And the idea of taking them is to get paid by them. And so if I've got a paid off property and I'm allowed access to 40% of the equity, I can take that as a lump sum payment up front and be done. Or I could take it as a monthly
annuity. Yeah, it's kind of like an annuity.
Yeah, exactly. I could take an additional $1,000 a month to supplement. I prefer the smaller supplementing, to be honest. First off, because you're not paying interest all at once on the money. And two, its job is to essentially offset your lifestyle expenses as your income goes down and your expenses go up, right? It has the benefit that you do only pay interest on what's been drawn, so don't draw it all right away. There are tools and mechanisms why you may want to draw large sums from an investment purpose, right? That's more your guys' territory than mine, right? And where that makes financial sense to do it, totally more in your territory than my territory to figure that out. It's just the mechanisms by which you access to that money, right? Now, if I've taken $1,000 and I owe, a $30 repayment, what's going to happen is that's going to get recapitalized into the mortgage, right? And so every month, my required payment for servicing that money gets capitalized back into that equity portion, right? So where I may borrow 30%, I may actually owe back 50%, right? Because we've got that recapitalization of payments. Now, the idea is that your property is growing at such a speed that, you'll die before you owe too much, right? And at which point your survivors, if it's for your kids, are given a 6-month window to liquidate that property or convert it to a traditional mortgage. The main reason why it might not be a bad thing to put onto someone is there's a survivorship clause in it. So if I passed away or had to go into nursing home or under care, that my spouse is still on that mortgage, is still receiving the benefits from it, still access at equity without me being a necessary participant, right? And so that survivorship piece is great. And if you're 75, 80, maybe that is something to look at, right?
Yeah. I think to give the listeners a little bit of context here, maybe I should have prefaced the question is, one of the reasons we do what we do as planners is to show the importance of being proactive as to how you're building your wealth over time. And one reason is because personally, I'm not here against real estate or for real estate, but if you build all your wealth into your real estate, you will end up with less options by the time you get to retire. And for a few reasons. One is you're not going to have any income anymore. So if all your wealth is tied to your home, then you have to turn to solutions like these, which personally, I think they're not great unless you're forced into them. But if you had proactive planning, or again, if we look at the cohort that we serve, where we help millennials, and I have done a lot of plans lately where you can tell that they're looking for a price point on a home that is way lower than what they could potentially afford, so that they can build wealth outside their home, so that by the time they get to retirement, they won't have to use these solutions because they'll be set up essentially in terms of liquidity. And that's really what the conversation is about.
Yeah, I agree with you 1,000%. There's way too much emphasis on buying and owning real estate as a retirement solution. It's not, because it's an income qualifying type program, almost universally, right? Once your income's gone, what are you going to do, right? You can't access the equity as quickly. You have to liquidate, or you have to utilize reverse programs, or you have to have established a home equity line of credit before you retire, when you still have income to qualify for it, right? And the maximum on that is limiting as well, right? So the line of credit portion of a home equity line of credit maxes at 65% of the property's value, right? You will always have a 35% buffer of equity in your property. You will never access the full thing that you bought, right?
Are those lines of credits guaranteed, or are they callable at certain points in time if the institution decides to de-risk their?
So all mortgages are callable. That's going to be the key, except for reverse mortgages, which have a clause in them. But all mortgages are callable, and you have to maintain either your property taxes, right? And those have to be in good standing consistently, right? You have to still stay within the borrower guidelines, right? You have to still make repayments. So if I borrowed, money on my line of credit, I still have to pay it. And if I stop paying it, what's going to happen, right? If I max it out to 65% and I no longer have equity room within it, and I start defaulting on my payments, it's called, right? The only solution from that, and the only way to pay that out in that position in life, will be through private lending, right? And you don't want to go into that route where we have to put an emergency private in, pay out a line of credit, and you sell the house, right? Because that's the solution to maxing out the equity position.
So basically, if you have all your wealth in your primary residence, obviously we're not talking about external real estate like rental properties, which can provide a retirement income, especially if they're paid off. Hopefully they're paid off by retirement. But we're talking about your wealth in your primary residence, and you don't want to sell your primary residence. And basically the only way to liquidate that is to have a home equity line of credit that you have access to, created while you still earned an income, or reverse mortgage. Because even if you want to downsize at retirement, and I get it too, because so many people, they paid off their home. Why would you sell it when you paid it off? And now you've got free space to live in, essentially, aside from the upkeep costs. Essentially, you're looking at your options are, if I downsize, I'm still downsizing in an expensive market. I'm not going to be able to utilize all the capital. or I take a reverse mortgage and now I'm depleting the equity in my home and negative compounding. Because if I take $10,000 a year, that 10,000 becomes 11,000, but I've only had access to 10. And so it's negatively compounding over time as well. And so I think, it's not like I always approach these things with a lot of skepticism, because I always ask, I don't know if you've seen The Big Short, where Steve Carell asks, how are we getting, in YouTube appropriate terms, how are we getting screwed here when he's being sold mortgage backs or the default swaps? And that's how I always approach these things when there's like this new innovative product on the market or something that I'm skeptical. It's like, okay, how are the clients getting screwed here? Like, walk me through the pricing, walk me through the details of this. And I feel like, okay, like you have negative compounding interest probably at a higher rate than just what a line of credit would offer you.
Absolutely.
And you're only able to access 50% of your, even up to 50% of your property value. And so, and you might be encouraged to take lump sums out at times where it may not be appropriate. And this is where planning needs to accompany this type of transaction.
The nice thing is, at least on reverse mortgages, they typically have a clause that requires independent legal advice. That's great, except most lawyers aren't up on reverse mortgaging, or up to understanding them very well. And so the ones that are typically on a list by that lender, right? That's not saying they're bad or anything, but lenders aren't in the habit of giving away things for free, right? They're in the habit of making a lot of money. And so we always have to approach what's in their benefit, right? And when I'm doing a transaction, I represent both parties, right? For sure, that's the whole idea of brokering. But, there has to be some transparency around the programs. What's in the benefit of each borrower and lender? I'm not a huge fan of negatively compounding interest. I see the point of these programs for people that have choices, right? I much prefer a recapitalizing line of credit like a Manulife One mortgage, or something that gives you the flexibility to choose whether to pay or not pay, right? Even when your standard HELOC, a Scotia Step, a TD Flex line, things like that, they have value. And I think, when you're leaving mortgage life, when you're getting ready to pay your home off, the last mortgage product you should always be putting on is a HELOC, right? You don't want to have to requalify 5-10 years later to tap equity if you need it for an emergency, right? Just know that it's going to be, there has to be payment due, right? It's not, there's no free money out there, right? But the retirement piece leads us onto a really cool one. And this is the third major rule change that's gone through. And that's the ability to refinance your property up to 90% of $2 million after improvement cost on adding additional living spaces into your home. This one's a big one. And we're still waiting for the lenders to really come out with guidelines on the rules. But essentially what CMHC has said is you can go up to 90% loan to value, 30-year amortization on a refinance insured by them to add a second, third, or fourth unit into your property that is not a short-term rental, but is actually a help fix the housing crisis scenario. And what this is going to do moving towards retirement. So if I was in my 50s today, I would be seriously considering, and had kids or something, looking at adding maybe one or two additional living spaces. It can be laneway homes, garden homes, reconfiguration to duplex, triplex, fourplex, right? So long as you're adding up to 4 homes, and the municipalities now have to let it happen. One of the good things that the Ontario government put through was those rules around zoning changes, right? But if you go through the permitting process, you get the quotes, we're looking at your after completed value of up to $2 million, lending up to 90% of that after completed value. So I could hand you a couple $100,000 to actually do the work, right?
So let's say, typical scenario, someone's bought a home a few years ago for $1.5 million. So they bought in 2020. The value of that property is now at $2 million. Their mortgage is at 1.35. They could essentially borrow back up to $1.8 million. So get an extra, $450,000. Yeah, $550,000. I think my mental math's off. Anyways, you get an extra hundreds of thousands of dollars, basically just borrow back, build an additional unit. As long as it's not a short-term rental, have people, and basically they're just trying to increase densification in cities like Toronto and say here,
Absolutely.
have more people
I,
live
I
here.
would do
Yeah.
You're off in London. I would do this in London every day of the week because there's a lot of great laneway homes available
Mhm.
there, or homes that are great to add laneway to or additional units to, just with the way they've been laid out, or garden homes. One of the even better than that though is, say maybe I bought a house for $1 million, and I go through and I build the plans, and I'm going to add a laneway house, and I'm going to convert my basement into a duplex, right? And the appraised aftermarket value is $2 million, right? And the cost to complete is, say, $800,000 to do this, right? Well, I can actually borrow that whole $800,000 to complete the project because the aftermarket completed value will be $2 million.
Yeah.
Or up
That's
to $2 million. So you don't have
crazy.
to have the cash in hand to do it. Now, granted, you do need some funds in hand because you'll be paying certain levels of completion permits, things like that upfront, right? This is not, I'm broke and I can do this, but I don't have to be sitting on hundreds of thousands of dollars to do this. This is a really great push to encourage generational housing. Can I, with my parents, create an environment in which my parents can age in place? I can have a home. I can help. We can work to pay it off together, right? Is this something that we can utilize, multi-generational living without stepping on each other? I'm a huge proponent of multi-generational homes. I think that's the key to financial success in the long run. I think that, the ability to have my parents, my siblings, aunts, uncles, whatever's necessary. If I can get more money working together towards a common goal, right, it opens up a whole lot more options. And if we can create 2 or 3 spaces where we're not stepping on each other all the time, right, because that's the downfall of multi-generational is, I love you, but I don't want to see you. Right.
Sure.
Please, if you can create that avenue, then maybe there's some opportunity there. And I think it's a great move. I think of all the 3 rule changes, this is my favorite. I think it addresses a lot of problems. And when we're moving into retirement, when we're thinking about that, what does aging in place look like? Right.
Mm.
Who will be the primary caregiver down the road? Right. And unfortunately, I think that's going to fall on a lot of our shoulders. Just when we look at the costs of late life care and things like that.
Yeah, it could be interesting to kind of see those scenarios where parents are aging and they basically found, like, if for me, for example, if I own my house, I could basically just say to my parents, hey, move in here, we'll build an extension on the house. And I mean, it's still money out of my pocket. There may not be money coming in from that, right? So there's some considerations there, but it's interesting. It's interesting. It's going to be, geez, I feel like there's so many ridiculous things going on right now, but yeah.
Let alone the biggest factor that now you have 3 full-time babysitters upstairs. So as you're expanding the family, you have the grandparents. I'm going to float that to Kayla's parents. I think this is a great idea.
Right?
There you go.
I think that works.
It's something that we forgot in the 50s, 60s, 70s, 80s, 90s, 2000s, right? Was the idea that households were bigger than just, me and my spouse and our kids. I'm fortunate. I grew up in a multi-generational household. I had my grandparents with me. My aunts and my uncles lived with me, right? We were on a big old farmhouse in the middle of nowhere, and there were a lot of us, right? But that meant there was always someone to educate, always someone to protect, always someone to do chores, always someone to provide, right? There were more incomes at play, right? And people weren't rushed through life as much, right? There were some major benefits to it. Yes, you have to get along. Oops. I can't end all my arguments with storming out. Okay, maybe there's a whole other topic there to discuss, but it's an option now that's on the table, and it's one worth exploring, right? Again, this is where expertise is useful. I've done construction projects, my team have done construction projects. You don't really want to sit down and do a construction project with someone who hasn't done construction before. It is complicated. There's a lot of moving parts. You need good advice on that, right? I would be working with builders that are used to this sort of thing, right? Are used to property expansions. I'd work with realtors even beforehand, right? Get advice from those that have worked in these kind of property expansions, right? Because it's a whole different animal than just, I'm going to add a sunroom, right? It's now we're talking about, we're adding whole additional living spaces. What makes right? We definitely have resources available to help with that with people that are interested in pursuing this.
Matthew, it's been a great episode. It's been amazing to have you on and have your insights. Where can the listeners find you?
Yeah, absolutely. So I know you're going to attach my social media below. Follow me on Instagram. The _Matthew Shantz is a great way. I try to post almost daily some sort of real estate educational information. You can find me on the Millen website. I've been able to partner up with Sam for the past year and a bit, and this has been a great arrangement. So your website has my contact information as well. I'm located downtown Toronto. My team is everywhere. We service all of Ontario and outside of. And so we're very happy to support. And I think, one of the best things, if real estate's something that interests you as a wealth creation tool, if it's something that interests you as is part of your retirement strategy, part of your wealth creation strategy, part of your tax strategy, to sit down with an expert, have a conversation, right? Go through the ins and outs and then really get into the right headspace. And so one of the things that my team and I do is really help provide that context around real estate as a tool. The mortgage is our tool by which we help people generate wealth, and get an understanding of it. It's not about the interest rate, right? The interest rate's the beginning of the conversation. Best rates are the beginning of the conversation, but there's so much more to have beyond that, right? And always surround yourself with knowledgeable, transparent, upfront, honest people who will tell you the truth as you go through this.
Thank you so much. Yeah. And as usual, you can find us, on mwadvisor.ca. All our socials are linked below. And of course, as a strategic partner, Matthew, I forgot that you would be there as well, but it's glad, following on Instagram and where he's mostly active. And of course, as we have, mortgage inquiries and whatnot, then here as a strategic partner, we work very closely. So whether it's coming through the mortgage first or maybe through a financial plan, we can basically serve you holistically under one umbrella. And that's the goal of having close strategic partners. So thank you again, Matthew. And
thanks, Matthew.
Listener, we'll see you in the next episode.